Now, let us understand and study a topic which is most critical for a new entrepreneur. This is the reason why most of the businesses fail in the first or the second year of its existence. Why? Because of financial planning and operations. So, what is the importance of financial fundamentals for entrepreneurs and why it is essential for them to keep an eye on the financial part? Now, the importance of financial management for entrepreneurs is to ensure sustainability of the business, profitability, and growth. Unless and until you get three of them, you won't be able to survive. Your business will be non existent within 1 or 2 years. So in order to sustain the business, in order to generate profit and grow your business every year from one point to the other, you require proper financial management for entrepreneurs. So what are the basic financial statements? Income statement, balance sheet, and cash flow statement. Now, these are the three basic financial statements which will help you to have a complete look on the financial aspect of your business. So if you want to start a business as an entrepreneurial venture, you need to be good in reading and analyzing income statement, balance sheet, and cash flow statement. For example, a successful entrepreneur closely monitors financial statements to track the revenues, the expenses, the assets it has created, the liabilities it has to comply with, and the cash flow. This will enable the business to make informed decision about its operations. Just imagine if I am running a business and I have no idea about my income, my expenditure, the assets that I have created. Will I be able to sustain the business? No. So, knowing the financial is the most important and critical aspect of being an entrepreneur. So, how do you create financial projections and budgets? Now, let us understand what is financial projection. Well, it is the estimate of a company's future revenues, expenses, and profit based on historical data and market trends. No matter which business you start, you have to make an analysis of the future projections. In the next 4 to 5 years, how much cash flow my business is going to generate, how much income I'm going to make after paying all the loans and the debts. Then comes the budget. Detailed financial plans that outline how a company will allocate the resources to achieve its goals. Now, every company has to manage and bring certain resources, take loans, borrow money from friends and family. And this has to be measured, this has to be allocated properly. For example, a startup founder creates financial projections and budgets to forecast sales, plan marketing campaigns, and determine staffing needs for the upcoming year. So understanding this aspect, making financial projections, is very important. Now let's quickly talk about cash flow, break-even point, and key financial metrics. Now what is cash flow? Now, in order to sustain, in order to run any business in this world, you need cash flow. If there is no cash flow in the business, your business is going to fail. Your business has to generate cash. The movement of money in and out of the business is crucial for maintaining liquidity and solvency. The future loan repayments will depend upon the cash flow. Whether you will get more debt will depend upon the cash flow. Whether you will achieve profit in the future or at present will depend upon the cash flow. So any business that you set up has to generate cash flow. The second aspect is break-even point. Now this is the point at which a company's revenue equals its expenses. This indicates that the business is neither making a profit nor incurring a loss. For example, you have started a business by investing 1 million. Now it took 3 years for you to generate revenue of 1 million. Now you can say that the money which I have put in of 1 million in the starting of the business, that money I have generated through revenue. This point after 3 years, I'm just giving you an example, is the break-even point. So it's a point where the company's revenue equals its expenses. Now key financial metrics. Now ratios and indicators that measure a company financial health, such as gross margin, net margin, return on investment, and current ratio. These financial metrics helps the banks, the investors, and the entrepreneurs to determine the profitability, to determine the growth in the business. For example, a restaurant owner tracks cash flow to ensure they have enough funds to cover expenses, calculates the break-even point to determine the number of meals required to cover cost, and monitor key financial metrics to assess profitability and efficiency.